The Nifty bank is off the blocks in style. Remember, the last couple of trading sessions, it's been losing its way.
The Nifty is climbing to all-time high levels and sustaining there.
A record high is what we saw on the Nifty today at that 19,520 mark.
Right now, we're close to 95 points away from that particular, from the highs of the day itself. The important part is today, it's weekly expiry, so the Nifty will be in focus and the Nifty will be doing its thing.
The Nifty scaled all-time high levels, crossed its previous peak, went on to hit levels of 19,567. The Sensex today scaled the 66,000 mark.
All right, hello and welcome to Markets Today, the show where we track about 6 hours of the day's trading action in 5 headlines. I'm Sonia Shenoy and here are all the top headlines for the day. A rollercoaster ride on Dalal Street, the Sensex and the Nifty hit a record high in early trade, but a late sell-off wipes out all the gains. Bank stocks lead the decline. Wipro's revenue declines nearly 3% in Q1 on constant currency terms. The company guides for a tepid revenue growth in Q2. Shares of TCS rise after meeting muted estimates in Q1, even as the management sounds cautious about the near-term outlook. HCL Tech shares slide after a weak Q1. The company announces senior management will not get any increments this year. Shares of PSU Bank see profit booking as federal banks' margins contract in the first quarter. The bank's CEO expects improvement from Q2. Anand Rathi soars on a good Q1. A brokerage upgrade sees Samvardhan Motherson gain, while a downgrade sees Power Grid shed 3%. Shah Metallics falls after promoters may have to dilute stake to meet SEBI's minimum public shareholding norms. And Nazara Tech and Delta Corp continue to see a fall after the GST Council's decision to impose 28% GST on online gaming. Revenue Secretary Sanjay Malhotra clarifies that the GST for online gaming was always at 28%, says it was the gaming companies which had interpreted it as 18%, adds that there was unanimity on the 28% GST rate. All right, straight to all the day's trading action. It was a big intraday swing and a sharp fall in the last hour, which saw Dalal Street end with minor gains. The banks led the decline, with PSU banks being the biggest laggards. The Sensex, Nifty and the Midcap Index failed to hold on to record levels that were hit in intraday trade. Surbi Upadhyay is here with all the details. Surbi.
Well, today will have to qualify as a bit of a disappointing day for the bulls. And the reason I say that, despite a 50-point gain on the index, is that it is for the 6th consecutive session that the Nifty didn't close above the 19,500 mark. In fact, it had everything going for it today. The momentum was very, very sharp. The Nifty and the Sensex both hit fresh all-time highs in the first 1.5 hours of trade. You had great global cues coming in. You even had buying in IT stocks. But despite all of that, the second half of the session turned out to be very, very different. Suddenly, there was a rapid fall in the mid-cap arena, and then it extended to large caps. A lot of the selling was led by auto stocks. There was selling in FMCG and then banks. Today was the weekly expiry for the Bank Nifty, and that index immediately cooled off after around 130 or so, and there was no meaningful recovery. On the Nifty, it was really the IT stocks that continued to fight back all the way, which is why towards the end we managed to at least close above 19,400, because in the last half hour, even that level had been breached. Reliance was another big stock that was reversing direction, adding pressure on the downside. But then, as I said, for what it's worth, IT saw the buy-on dips play out, and classic, very smart buy-on dips. TCS, Infosys, even LTI Mindtree, which makes its debut on the Nifty. These stocks had some gains. HCL Tech also didn't fall too much, despite that howler of a number coming in for the first quarter. Just a word on midcaps. Now, the Midcap Index has closed down about 0.7%. Specifically want to point out that there was more selling today on Delta Corp and Nazara after the clarifications came in from the Revenue Secretary to CNBC-TV18 about the 28% GST level for casinos and online gaming. Interestingly, however, some of the new age companies ended positive. So let me end on that optimistic note. We had good buying on Zomato, for instance. Even Delivery and PB Fintech managed to find some gainers. But overall, a lot of volatility. So we need to watch out for tomorrow's session very carefully.
All right, Surbi, thanks a lot for that. But moving on in market opinion, Atul Suri, the CEO at Marathon Trends PMS, bets on the banking sector and NBFCs. He adds that he will wait for the large tech stocks to settle down and he prefers mid-cap tech stocks. Take a look.
If you look at the internals of the market, you will feel sectors. It's very broad-based. It's not one or two sectors that are driving it, whether it's your banks, whether it's your local infra, plays, NBFCs. There's a lot of breadth that's happening. Bank Nifty is something you can't ignore because that has so much weightage. It tends to, sort of lead things. And whenever rallies happen without banking, it's always dicey. But the good part is, as I said, it's very broad-based. Wherever the touch of electric mobility or promise of electric mobility is there, you'll find that the moves have been stellar. Some in the small and mid caps are like disbelief. They've beaten what IT stocks did. After banking, in terms of weightage, tech is probably the second highest. Maybe energy is there or somewhere there. So from that point of view, tech is something that cannot be ignored. So for me, tech as it stands today is probably the large cap. Let it settle down, let the trends emerge. But there are definitely very good trends in some select mid-cap IT spaces. So I think you can participate through them.
Okay, and on to the second headline now. Software major Wipro has just released its first quarter numbers. The revenues declined nearly 3% in Q1 on constant currency terms. The company's guidance projects a tepid revenue growth in Q2 and even warns of another contraction. Rima joins in with more details on that. Rima, over to you.
Thanks so much for that. So it's a weak quarter, but in line with muted expectations. The street was not expecting fireworks this time, and it's been a weak performance. So constant currency revenue growth has contracted by 2.8% on a quarter-on-quarter basis. Now, Wipro had told us last quarter, that in Q1, revenues for the company will either fall -1 or up to -3%. What the company has delivered at -2.8% is at the lower end of their own guidance and slightly worse than street expectations, which were at -2 to -2.2%. It's also worse compared to peers. So TCS had a flat growth this time, and HCL Tech had a -1.3 performance. The guidance for the next quarter is quite crucial, and here the company is guiding for -2 to +1%. So the good part in the guidance is at least they're holding out the possibility of a positive growth, because consensus expectations was that the guidance for the next quarter will either be 0 to 2 or -1 to -3%, which basically means everyone was expecting for a negative growth in Q2. But at least Wipro is holding out the hope for a positive guidance. Margins have declined by 25 basis points. There is no wage hike impact, so the weakness in margins is purely because their revenues have contracted. Deal wins continue to be robust. This is something that we've seen across for the industry. Total bookings at $3.7 billion is slightly lower compared to what we had in the prior quarter, but the large deal bookings at $1.2 billion is a pickup on a sequential basis. I think the bigger miss and a telling sign in Wipro's numbers this time is the very sharp headcount addition. Headcount for the company has fallen by more than 7,000 employees on a quarter-on-quarter basis. We're looking at a big contraction in the company's headcount. Just to put it in context, TCS at least managed to increase their headcount by 500. For HCL Tech, it was a revenue headcount decline of 2,500. But for Wipro, at more than 7,000, this is a weak number. Attrition, as we've seen with the case of others, has fallen by 17.3%. Thierry Delaporte, CEO, MD of the company, says despite a gradual reduction in clients' discretionary spending, we maintain new business momentum, basically referring to the deal wins that the company has announced. So all in all, it's a weak showing, but it's predictable, in line with what the street was anticipating. Back to you.
Okay, well, thanks a lot, Rima, for that. Well, TCS reported muted set of numbers in the first quarter as expected. However, the deal wins came in as a silver lining as it stayed above $10 billion for the second straight quarter. Speaking to CNBC-TV18, CEO Kriti Vasan said that while the total contract value remains strong, he is unsure when the macroeconomic uncertainties will subside. Take a look.
Our position is like you saw, our TCV is continued strong. But we do see that our volume growth in terms of revenue and it's persisting in variety. So it's too early to call, and also we don't know when the macro uncertainties will subside. And if somebody tells us that okay, it will subside by next quarter, we'll say then from then on there will be more optimism.
All right. Well, moving on, HCL Tech reported a big miss on revenues and margins for the first quarter of FY24. The constant currency revenue also slipped over 1%, contracted for the second quarter in a row. The company, however, maintained its growth guidance for FY24. The MD and CEO, C. Vijay Kumar, has said that challenges in tech and telecom hurt the overall performance, but added that he expects business to recover from here on.
We have challenges in tech and telecom because we saw some more ramp downs during the quarter, more than what we expected. And that's what has resulted in a decline in these two verticals, serious decline. But we do believe things will recover from here on. We've always maintained that our guidance is organic, so 6 to 8% is organic. Whatever contribution from ASAP will be incremental to the organic guidance numbers that we've shared.
Well, the third headline today, Federal Bank posted its first quarter earnings. It disappointed the market. The stock fell over 5%. The bank's margins contracted, and that led to a sharp decline across banking stocks. Do keep in mind these stocks have been rallying for the last few weeks. Let's go straight across to Abhishek, who joins in with more details on that. Abhishek, over to you.
Well, cost of funds have weighed on the P&L performance of Federal Bank. Take a look. Interest expenses up 10.5% sequentially, while deposit growth is at 4.3% quarter-on-quarter. So the net interest margin has declined to a 2 to 3 year low of about 3.15% for Q1 FY24 when compared to 3.3% in the previous quarter. The NII that is coming at 1,918.6 crore. We're working with a number of 1,963.2 crores. The other income is also down 0.2% quarter-on-quarter, and the operating profit as well, which is down about 2.4% quarter-on-quarter. However, PAT has come in at 853.7 crore. We're working with a number of 837.9 crore. In terms of asset quality, it's a seasonal hiccup that is seen over there. Slippages have increased a bit to about 490 crore when compared to 454 crore in the previous quarter. In terms of absolute value, gross NPA is up 6% quarter-on-quarter, and net NPA is up 5.77% on a sequential basis. However, as a ratio, gross NPA ratio has increased by just 3 basis points on a sequential basis to 2.39%, while net NPA ratio has remained flat on a sequential basis at 0.69%.
All right. Meanwhile, Federal Bank CEO Shyam Srinivasan expects margins to improve from the second quarter. He's also upbeat about sustaining the business growth rate at 20%.
We see a 7-8 basis point improvement in NIMs in the quarter two, and then from there we will see how the mix of the business plays out and business momentum. But yes, we are seeing the pickup visible. For the year, we had guided we'll grow in the high teens, 18 to 20. We started well with 20% growth in Q1. At this point in time, I believe that should sustain.
Okay, let's shift focus now to India's pharma and healthcare sector. Analysts are expecting around a 10 to 12% revenue growth and margin expansion. This time around, Ekta joins in. Ekta, tell us more.
Thanks for that. Well, yes, I'll start with the mother market, the US. The US could grow as much as around 10 to 12% for some pharma companies year on year this quarter. Growth could be led by sales of key drugs offsetting facts such as price pressure. For example, cancer drug Revlimid generic for the likes of Dr. Reddy's as well as Zydus Life. Generic Prezista for Lupin, biosimilars for Biocon, and specialty drugs such as Ilumya for Sun Pharma. Lower sales of albuterol, which is an inhaler, and US FDA issues at Cipla's Indore unit could weigh on the company. Now, moving to domestic formulations, growth will continue to be driven by factors such as price hikes and better volumes. Estimates are around a 10% growth on a year-on-year basis. The likes of JB Chemicals, Eris Life, and Torrent will be aided by recent acquisitions such as Sanzyme and Oaknet and Curatio, respectively. Margins are expected to improve as much as around 50 to 70 basis points on a sequential basis and as much as 3 to 4% year-on-year for some companies. Now, margin improvement is going to be led by factors such as sale of key drugs in the US, lower raw material and freight costs year-on-year. Talking about margins, watch for Divi's Labs and Laurus Labs. The street is anticipating as much as a 300 basis points Q-on-Q margin improvement due to better gross margins for Divi's. Laurus Labs, another story. It could continue to be weighed down this quarter after it reported a multi-quarter dip in margins in Q4. Otherwise, API companies' revenue will be aided by improved demand year-on-year. Commentary on Lupin's launch of Spiriva generic, Sun Pharma's guidance on clearing the import alert at Halol and Aurobindo, and Gland's outlook on injectable sales in the US will be watched. Lastly, for healthcare companies, hospital revenues are expected to grow 12 to 13% year-on-year, aided by as much as around 50 to even 500 basis points improvement in occupancy as elective surgeries and international medical tourism aid year-on-year. Max is likely to lead on revenue and margin improvement. Apollo Hospital's profitability is likely to be dragged lower by losses in the 24/7 arm. For diagnostic companies, expect high single-digit volume growth in patient volumes. Margins could stabilize Q-on-Q but remain under pressure year-on-year due to competitive intensity. Let's, as always, leave you with a quick snapshot of pharma and healthcare companies in terms of an FY24 PE, the likes of Aurobindo, Lupin, Cipla, Divi's. Remember, a lot of these companies have seen significant run-ups. On the diagnostic front, Dr. Lal's and Metropolis, and for hospitals, it is EV to EBITDA for the likes of Max, Apollo, which are the more expensive ones, and Fortis Healthcare.
All right. Thanks a lot, Ekta, for that. Well, let's slip into a quick break. We will be back with the other headlines shortly. Do stay tuned in. Welcome back to Markets Today on CNBC-TV18. The fourth headline today, Anand Rathi rallied nearly 8% on good first quarter numbers. The company's revenues came in at close to 180 crore rupees versus 147 crore rupees seen last year, while profits rose 34%. Surbhi Sutaria joins in with more details on that. Surbhi, over to you.
Thanks so much for that. So Anand Rathi reported a good set of numbers. Now the revenue was up 21% on a sequential basis. The PBT was up nearly 19%. Margins were a tad bit lower at 39.7% versus 40.5% in the previous quarter, but the operational metrics were pretty strong. The number of active client families were up nearly 5%. The net flows in their private wealth business, that was up 3.5%, and their trail revenues were up nearly 6% on a sequential basis. Number of relationship managers, that was also up 5% sequentially. Now that number has been stagnant for the most part of the last fiscal, so you can see an uptick in that number as well. And apart from that, they have achieved 25% of their entire FY24 revenue and PAT guidance. So good numbers coming in from Anand Rathi Wealth.
Okay, all right. Thanks a lot for that. Good numbers coming in from Anand Rathi Wealth. The other stock that was in focus today was Samvardhan Motherson. It gained 1% after brokerage firm Jefferies upgraded the stock's rating to a buy. In fact, they not only upgraded to a buy from a hold, the target price was raised to 115 from 70 earlier. Jefferies talks about how Samvardhan is having an improving earnings trajectory. After 4 tough years, SAMIL's operating performance has now started to improve, and they've also upgraded the FY24 and 25 EPS by 18 to 42%. They also expect a strong growth led by the improvement in the core business. And apart from that, the 2 acquisitions that Samvardhan has recently made, which is SAS and an 81% stake that they bought in Yachio's 4-wheeler business, that will aid their earnings this time around. Jeffrey expects the 2 acquisitions together can add 15% to SAMIL's FY25 revenues. So that was one big mover in trade today. But in other stocks in the news, Power Grid fell 3% after Bank of America Securities downgraded the stock to an underperform. Vivek is here with more details on that. Vivek, over to you.
Well, that's right. Power Grid, one of the top laggards as far as the Nifty is concerned today. A very interesting note coming in from BofA Securities. What they've done is they've downgraded the stock, and the rating now is an underperform rating from a buy stance that they had earlier. The target is retained at 259 rupees a share. Now, what they're saying is that near term, they are seeing significant pressure on the company's return on equity on the back of 3 main factors. Number one, what they've done is they've done comprehensive channel checks, with the Power Ministry as well as regulators. And what they're saying is that the CERC, which is likely to go ahead and publish a draft tariff regulation by October to December 2023, and that will be for the next 5-year period from FY25 to FY29, you could actually see a significant amount of dilution or reduction as far as ROEs for distribution companies are concerned. What is the reason for that? They believe that the power sector, distribution sector especially, has now matured, and there is no need to incentivize further investments into this particular space. Secondly, what they're saying is that the company's higher participation in lower ROE, TBCB projects, which are tariff-based competitive bidding projects, is also something that could drag down ROEs further. Lastly, what they're saying is that the company that is going ahead and making its entry into new business ventures, even these ventures are ROE dilutive. On the back of significant pressure that they anticipate in ROEs going forward, they've gone ahead and downgraded the stock. Apart from that, they also believe valuations at this point of time compared to historical price to book valuations are quite pricey, and that has also prompted a downgrade from BofA, which has led to significant selling pressure today.
All right. Thanks a lot, Vivek, for that. Well, in more stock-specific news, Shyam Metallics ended with cuts of over 2%. We learned from sources that the promoters of the company may dilute their stake to meet SEBI's 25% minimum public shareholding norms. Promoters currently own 88% stake in the company. Yash Jain is here with more details. Yash, what are you picking up?
That's correct, Sonia. So the company that we're talking about is Shyam Metallics, and what we've been given to understand is that the promoter and the promoter group could dilute stake as much as 13% in the company, and that is expected to happen in this current calendar year itself. What we've been given to understand is that currently promoter and promoter group have about 88% stake. This, to comply with the minimum public shareholding norms of SEBI, need to be brought down to 75%, which means it will require a total dilution of about 13%. As per our sources, the company and the promoters of the company are planning to sell this 13% stake or dilute their 13% stake in 2 tranches. In the first tranche, they would look to dilute about 6 to 7% stake, and that could be done through a QIP issue. As far as QIP issue is concerned, since it's a company issuing fresh shares and the promoter shareholding coming down, the money will also come into the company, and that could be to the tune of 800 to 900 crore rupees. Now, once this first tranche of stake dilution is completed, then the promoters could look at a second tranche, which could be another QIP issue or an offer for sale from the promoters. Works similarly, if it's a QIP issue, another set of funds would come into the company. If it's an OFS, then the promoters would take the money. We've written to Shyam Metallics on this particular development. What the company has replied to CNBC-TV18 is that they've not yet finalized the modalities of the promoter stake dilution, and any talk about a QIP issue or an OFS issue is purely speculative at this point of time.
All right. Thanks a lot for that, Yash. Well, the fifth headline today, gaming stocks, Nazara Tech and Delta Corp got beaten down in trade for the second day. Nazara Tech fell over 3% and Delta Corp tumbled over 5% on the back of a clarification coming in from the Revenue Secretary, Sanjay Malhotra. He said that taxation on online gaming was always at 28%. He also added that there will be no question of retrospection.
You said that the 18% GST on the gross gaming revenue, which is in effect at this point in time, is the interpretation of online gaming companies. Are we to understand then that these changes will apply retrospectively? So the 28% on full value will apply retrospectively?
That's why I said, that the rate has always been, to our mind, to our understanding and interpretation, also held, by our ASG, is that it is 28% on the full value, on this, not the GGR, but the full or the face value, as some people call it. And so it's basically a clarification. And so this is
a very important clarification.
Yes, and so it is already having effect as of date, and so there is no question of a retrospectivity because it's already 28% on the face value, and we continue to charge that. Prospectively, this doubt no longer remains. That's the only difference.
All right, with that, it is a wrap on this edition of Markets Today. Thanks a lot for watching.